Hi everyone. In this video I am going to walk you through an accounting problem where we have to book a series of entries and then build T accounts and then finally conclude by creating an unadjusted trial balance. So let's hop over to the computer and dive into this problem. Alright, so in this problem the company we are looking at is Halogen Laminated Products Company, and they began business on January 1st, 2024. During January, the following transactions occurred. So we have a series of transactions here. They all occurred in the month of January, and from this we have to prepare journal entries to record each transaction. And then step 2, we're going to post those entries to T accounts. And finally, we're going to prepare what's called an unadjusted trial balance. So what we're really doing in this problem is the beginning of the accounting cycle. So if you remember from Module 1, the accounting cycle is that process that we go through to take transactions that happen out in the real world, those economic transactions, record them through journal entries, post them to T accounts, and then prepare an unadjusted trial balance, prepare financial statements, prepare an adjusted trial balance, and then finally close the books, close the temporary accounts, close the revenue, expense, gain, loss accounts, close them out and put them into retained earnings. All right, so it's that whole process or that whole cycle. And it's called a cycle because we do it over and over again every year, every financial reporting period. So we're going to do the beginning part of that process, and let's talk about adjusted versus unadjusted trial balance. So an unadjusted trial balance is a trial balance that has not been updated for adjusting entries yet. Okay? So trial balance is just a listing of accounts. So we'll have a listing of cash, receivables, and then over here in this column we'll have accounts payable. And what this report will basically do is list all the balances for all of our financial statement accounts. And so this is 1,000, maybe this is 2,000, and this is 5,000, and so on and so forth. And it goes down every single financial statement account and it lists it out. All right. So we are going to prepare the unadjusted trial balance. It's the trial balance before adjusting entries have been recorded. And so what are adjusting entries? Adjusting entries are made to update account balances, right? They are going to be used to fix errors. And generally, they're recorded in 3 different situations. All right, so we're going to be doing prepaids. If there is a prepaid expense, that will result in adjusting entries being required. Accrual accounting will also require adjusting entries. And then finally, estimates. Any accounts that require some type of estimate will need to have adjusting entries recorded at the end of the financial reporting period. And so what these are doing, what our adjusting entries are doing, is they are updating these accounts for what we would call internal economic events. So things that happen within the company where there's no transaction with a third party that would tell us that we need to record a journal entry. These internal economic events, you just need to know that you need to record them each financial reporting period by looking at the list of accounts. For example, if you have prepaid insurance, right? You debit prepaid insurance, right? You're paying in advance for an insurance policy, and you have, let's blow this up a little bit for you guys. You debit prepaid insurance and maybe you credit cash, right? And so this would be, you have a $30,000 entry, right? So we're going to say that this covers a 3-year period, right? And then we get to the end of the year, we've used some of this insurance policy. Now, when we get to that end of the year, the insurance company's not going to send us a bill. We've already paid it. we paid in advance for this insurance policy. So there's no real world transaction that tells us, hey, we need to record the expense because we use some of this policy. The only way we know that we have to record this entry is we look down the listing of our accounts and we say, hey, we have a prepaid insurance account here, and I know that we have used some of this policy during the period, therefore we need to update the prepaid insurance account. We need to say insurance expense, and we are going to credit the prepaid insurance account. Why a credit? Because prepaid insurance is an asset. It provides future benefits to the company, and we need to reduce it. So to reduce an asset, we do a credit. And so, I'm sorry, this is for 1 year. So I'm going to say $10,000. 3-year policy, $30,000. 30,000 divided by 3 is 10. So recognize 1 year of insurance expense. All right, that's what's going on here. All right. So these would be adjusting entries. This whole, or this entry right here would be an adjusting entry. Only this second entry is an adjusting entry, right? This is the original transaction. This is an ordinary journal entry. And then this is the related adjusting entry. And so the unadjusted trial balance would capture only this, and then the adjusted trial balance would reflect, it would include this second adjusting entry, right? So long-winded explanation for what an adjusted versus an unadjusted trial balance is. All right, hopefully that was helpful. So let's set up our problem here, though. Okay, so I'm gonna say let's reset this. I don't want the colors. I'm gonna create a column for debit account, credit account, and then I'm gonna say debit amount and credit amount. Okay. And then I'm going to say January, so this is going to be the date in January. Alright. You guys with me so far? Alright. So we have, let's just make this bold so you guys can see what's going on. Let's see. Alright. What did I do? Come on, Tom, get your head in the game. Alright, let's see. I'm going to do a border here. Bam. Alright, so we have everything set up. Let's make these columns big enough so we know what's going on. Alright, January 1st. What do we have going on here? So I'm going to just center this column. Sorry about this, guys. So I'm going to say these are going to be in, let's make this dollars. And let's just test this. I want to make this in whole dollars. I don't want all those decimals. Alright, that works. Alright. Sorry guys, I had to get myself set up here. So, issued common stock in exchange for $100,000 cash. What do we do here? We're receiving cash of $100,000. So we're going to say debit cash. And in exchange for common stock, right? So we're going to say paid in capital. So we don't know if it's in the form of APIC or if it's just par value common stock. So we're just going to say paid in capital. Catch all. So we're going to say 100,000, 3, right? And then this is going to be equal to that. Bam. We got it. All right. Number 2, January 2nd. Purchased inventory on account for $35,000. All right. So we're going to say debit inventory, right? We have inventory coming into the company. It's purchased on account, it says. So I'm going to say accounts payable. It would help if I could spell. And so this is going to be 35,000. Okay? 35,000. Oh, why am I doing that? Let's do equals. So the nice thing about doing this thing in a spreadsheet is you can use formulas and, you know, it makes it so I don't have to write things multiple times. Alright, so January 4th. Paid an insurance company $2,400 for a 1-year insurance policy. Okay? Prepaid insurance was debited for the entire amount. Alright, so we're going to say, they're telling us what the entry was. They're saying prepaid insurance, and we're going to credit cash. The only way you can have a prepaid insurance account is if you pay cash. All right, we're going to say enter, and this is $2,400. Now, oops, so we got that. All right, so let's look at January 10th. What do we do here? Sold inventory on account for $12,000. All right, so we're going to say debit what? Sold inventory on account. That's telling us it's an accounts receivable. Receivable is when we make a sale to a customer. Accounts receivable, okay? And we sold inventory on account for $12,000. Oh, sales revenue. All right, so this is going to be $12,000. Pretty good. All right. And remember, there's always two parts to a sales transaction. You're going to have the sales piece, and then you're going to also have the cost of goods sold piece. And so the cost of goods sold is $7,000 here. And we need to reduce our inventory by that amount. So we're going to say $7,000. All right. So we got both entries there. The 15th. Borrowed $30,000 from a local bank and signed a note. Borrowed $30,000 from a local bank and signed a note. So we're going to say cash, right? And we're going to say note payable. $30,000. All right, $30,000. All right. How about 20? The 20th. Paid employees $6,000 salaries. I'm sorry. Paid employees $6,000 in salaries for the first half of the month. All right, so we're going to say salaries expense, right? And then we're going to say cash. Now you might say, why is it not salaries payable? Well, because they're saying we paid employees, we paid cash. We did not have to accrue it yet because we made the payment, and we're not at the end of the month yet. We're still at the 20th. All right. So this is a straight cash transaction. The 22nd, sold inventory for $10,000 cash. All right, so we're going to say cash, 10,000. And what is it? Sold inventory for 10,000. Okay, so we're going to have, it's going to be the same as what we did before. Sales revenue. So 10,000. This time the customer paid cash rather than a receivable. We're going to have cost of goods sold, right? And then we're going to say inventory, right? And the inventory is going to be what? $6,000, right? They say $6,000, right? Equals this, blah, blah, blah. All right. Let's go down to the 24th. What happens on the 24th? Paid $15,000 to suppliers for the inventory purchased on January 2nd. So back on January 2nd, we bought inventory, cost $35,000. Now we're paying $15,000 of that. So we're going to say debit accounts payable because we want to make the liability go down. We don't owe as much anymore. To make a liability decrease, you record a debit. And so this is going to be debit accounts payable, credit cash. This will be for what? 15,000, right? 15,000. Good. All right. How about 26? On the 26th, collected $6,000 on account from customers. All right. So we previously sold some stuff on account. We had accounts receivable, and now some of the customers are paying us. And we're going to say cash, accounts receivable. And this is going to be $6,000. Okay. And then we have the 28th. All right. Paid $1,000 to the local utility company for January gas and electricity. So we're going to say we're paying it. So we don't need an accrual here. They're saying we paid cash. So this is a cash transaction. Paid cash. And this is going to be utilities. Why can't I spell today? Utilities. expense. Right, cash. Utilities will be what, $1,000. Okay. All right, and then on the 30th, last one. Okay, 30th. Paid $4,000 rent for the building. Okay, so we're gonna say we're definitely crediting cash here. Okay, we paid $4,000. All right. $2,000 was for January rent. Oh, and $2,000 was for February. So part of this $4,000 payment, half of it, is for next month. So we are going to have two debits here. The first is to rent expense. And the second is to what? You know it. Come on, guys. Come on, you know it. I know you know it. Let's go. What do you got? All right, you're exactly right. I'm glad you said that. It is prepaid rent. Nice work. I appreciate that. So we're going to say 2,000 here, 2,000 here. Oh, come on. Let's go. Come on, let's get this formatting right. All right. So we now recorded all the journal entries. Number 2, we have to post these to T accounts. All right. So what's that mean? Let me see here. I'm gonna, if you guys don't mind, I know that you don't, I'm going to zoom out a little bit so I can start creating these T accounts. And so what I want to do is I'm going to go down each column, make sure I get every account, because every one of these accounts in this column needs its own T account. Every one of the accounts in the credit column needs its own T account. All right, so we're going to say cash. We are going to say, you know what, maybe I'll just, let me see something here. I'm going to just make it easy for myself. All right, and then I'm going to say center this, right, and then I'm going to put the border on there, and maybe I'll do a little left border here. What do we got? What do we got? Come on, Google Sheets, give me a left border. Oh, I like it. All right, so I'm going to just basically copy this. So I'm going to say rent. This is going to be inventory. And then I'm going to say what? Prepaid insurance. Prepaid insurance. Let's see. Then we got accounts receivable. Right. And then what? Cost of goods sold. Good old COGS. That's for the cool kids. Only the cool kids know the abbreviation for cost of goods sold. Cost of goods sold, blah, blah, blah. And then we're going to do, we already have cash, right? We don't need that. We need salaries expense. Let's put this down here. All right, salaries. Come on. Okay, and then we need cash again. We have cash. We have cost of goods sold. We do not have accounts payable yet, though. So let's put that down here. Accounts payable. Accounts payable, right? And then we have cash again. We don't have utilities expense yet. Let's put an account for that. All right. Utility. Come on. And then we have, do we have rent expense yet? No. We don't have rent expense. Rent expense and prepaid rent are the last two. All right, prepaid rent. We're rocking and rolling here. Prepaid rent. All right, easy enough. All right, then over here, let's make this 10. Okay. And then I'm going to basically do all of this again, copy all these accounts. Hopefully I don't need as many on the credit side. Let's see. So I'm going to say, let's see, paid in capital is the first one. Paid capital, good old PIC, pick. Sometimes you have a pick, sometimes you have pick. And then I think we have accounts payable already. We don't need that. We have cash already. We don't have revenue. Sales revenue. And then we need inventory. Do we have inventory yet? Yeah, we do. It's right there. Come on, Tom. Notes payable. I don't think we have that. Notes payable. And what else? Cash we have. Revenue we have. Inventory we have. Cash we have. Accounts receivable we have. Cash we have. Cash we have. Okay. So we got everything we need here. Let's get rid of these bad boys. Let's clear our formatting. Let's see. No borders. Alright. I don't want to merge these guys. Let's make it all nice and clean. Alright. Now we're good to go. Okay. So what I'm literally going to do is I'm going to just post these things. I'm going to put them into their T accounts. So here we have $100,000 as a debit and paid in capital over here of 100,000. So I've now recorded journal entry 1. I posted the entry to the T accounts. So I'm just going to mark this so I know I completed it. Now inventory is a debit of 35,000. Accounts payable are where are my accounts payable? Down here. Accounts payable is going to be a credit for 35. Okay. All right. Got that one. Prepaid insurance is going to be a debit, and cash is going to be a credit. Right there. What did I do? Equals debit. Got it. Alright, that's done. Let's mark this done. Accounts receivable. So this is going to be 12,000. And then sales revenue, 12,000. Okay, you can see what I'm doing is I'm just recording, I'm literally posting these into the T accounts. And posting means I'm taking the journal entry and I'm putting them into the general ledger accounts. Cost of goods sold here. A general ledger, by the way, is a collection of T accounts. So cost of goods sold here is going to be 7,000. Inventory is going to be 7,000. All right. Clear this out. We're done. Okay. Cash. All right. So we're going to say cash 30,000. All right. So we're going to say debit cash 30 grand. All right. Credit notes payable 30 grand. Easy. All right. This is easy. This is why I love accounting. It's so structured, so organized, easy to figure out. We have salaries expense, $6,000 equals 6,000, okay? And then we're going to credit cash. So I ran out of space here. So what I'm going to do is I'm just going to make myself some room. Alright, move these down a little bit. I'm going to credit cash for 6,000. Where are we at here? 6,000. There we go. Alright, let me expand this a little bit. So I'm going to say left border. There we go. Okay, so we got that. That's good to go. I'm going to put my fill in here to mark it done. Alright, and then we receive cash of 10,000. Debit cash 10,000. 10,000. Alright, and then we have sales revenue of also 10,000. Equals 10,000. Okay. Alright. Let me see here. Alright, that's good. Cost of goods sold 6,000. Alright, so we're going to debit cost of goods sold 6,000. Credit inventory 6,000. There we go. Yeah, easy enough. Okay. And we're going to say accounts payable 15. Where is my accounts payable? There it is. Alright, debit accounts payable. We're not crediting. Alright, 15. Cash. Oh, man, I gotta make more space again. Come on. Let's drag this down. Alright, and it's credit cash 15. Okay, done. Alright, mark this done. here, and then make this border longer. Left border, okay. And then now, if you wanted to be really organized, what you can do is you can mark each of these numbers that are appearing in the T accounts. You could put the date down, the date from January right next to it. So, for instance, I could put 1 here, just to mark that it's from journal entry 1. Now, it's not necessary, but if you want to really take your organization of these T accounts to the next level, you can certainly do that. How about cash? All right, so the next entry is debit $6,000 to cash. So I'm going to say debit 6,000, and then I'm going to say accounts receivable credit 6,000. So I'm going to say, remember, the debits are on the left of the T account and the credits are on the right. Utilities expense, $1,000. All right, so we're going to put this here. So we're going to say utilities expense 1,000, cash 1,000. Oh man, I need more room again. Turn this down. So this is going to be 1,000. Got it. All right. So let's mark these last two done. I forgot to mark the previous one. All right, last one, rent expense. Debit rent expense for 2,000. So debit rent expense 2,000. Debit prepaid rent 2,000. And finally, credit cash for 4. There we go. We recorded all of these entries, or we posted all of these entries. And let's put this border here. So we save that. Alright, so now we have our T accounts. We're finished with part 2. Alright, final step in this process. What we want to do is sum up all of these T accounts and then list them in an unadjusted trial balance. So I am going to let me move this down a little more. Let's total up the T accounts. Alright, so we're going to say, put a border here. So I'm going to say sum of the debits minus the sum of what? The credits, right? And that will give me my T account balance. So I have a debit balance of $117,600, and what I'm going to do is I'm going to start my unadjusted trial balance. So I'm going to say, what is this company? This is Halogen Laminated Products Company. Oh, come on, Tom. I was going to write jalapeno. Halogen Laminated Products Company, right? Okay, let's center that bad boy, and then we're going to say for the month ended January 2024. And we're going to say unadjusted trial balance. Again, center this, and then we're going to say, we're just literally going to list all these accounts, and we're going to take their balances. So we're going to say, this is the account, and this is whether it has a debit balance and then a credit balance. Alright, so let's do all the accounts first. I'm going to say, I'm just going to link these up. Cash, inventory, equals prepaid insurance, equals accounts receivable, equals cost of goods sold, equals salaries expense, equals accounts payable, equals utilities expense, equals rent expense, equals prepaid rent. Alright. Okay. And let's make this a little bigger. And then I'm going to do all the accounts from the other side. I'm going to say equals paid in capital, equals sales revenue, equals notes payable. Okay, so we got all the accounts listed, and so my cash balance is going to be that, right? And then I don't want you to autofill it. So inventory. Now I could go through and set up all the calculations here in each T account, but or I could just do it here. I could say for inventory, take the sum of this and subtract the sum of the credits. All right. So $22,000 of inventory. Prepaid insurance, I'm going to do the sum of the debits minus the sum of the credits. Right. Accounts receivable, I'm going to do the sum of the debits minus the sum of the credits. Okay. Cost of goods sold equals the sum of the debits minus the sum of the credits. When would you, pop quiz, when would you have a credit to cost of goods sold? See if you can answer that. Equals salaries expense is there, right? Minus the sum of the credits. Okay. Now, accounts payable is normally, it's a liability, so normally it has a credit balance. So I'm going to do my calculation over here, and I'm going to do the sum of the credits minus the sum of the debits. All right, so I'm going to do this minus sum of this. Right? Okay. Utilities expense. I'm going to do sum of the debits minus the sum of the credits. It looks like I have a formula error here. I forgot my parentheses. So then rent expense, again, that's going to be a debit because it's expense. Expenses end up in retained earnings. And then I'm going to do sum of, okay, and then prepaid rent, I'm going to do the sum of the debits, right, minus the sum of the credits. Okay, alright, and then paid in capital, we're going to do sum of the credits, right, because this is an equity account. Equity accounts have a credit balance usually. Their natural balance is a credit balance, so I'm going to do a credit minus a debit. Sales revenue, same thing. I'm going to say sum of credits minus the sum of the debits. Alright. And then finally, notes payable, I'm going to say the sum of the credits, that's a liability, minus the sum of the debits. Okay. Oh, come on. Google Sheets, you're driving me crazy. What do we do here? Oh, I got an extra parentheses in here. Get out of there. Alright, so if I did this correctly, I should have total debits equal to total credits. So I'm going to say sum of these guys. Right, and then I'm going to say sum of these guys. What does that look like? Alright, we got it. First try. How about that? Alright. Now, let's make this look nice. We're going to bold. I'm going to center this. Actually, I'll leave this one left. Justify. Let's put a border on this guy. What do we got here? Border. And I'm going to bold this section here to make it look nice. Put this down here. I'll do bold. And then I want these guys to have that summation notation. Let's see, I want the double border. Alright, so I'm going to say, where'd the double border go? Oh, I want this guy. Alright, there we go. Alright, and then we'll put a single border here. Oh, nope, not that. Put this guy. Alright, there we go. Alright, so there is our unadjusted trial balance. Now, the last thing I want to note here is that usually when you have an unadjusted trial balance, or any trial balance for that matter, You're going to list these accounts with the balance sheet accounts first, followed by the income statement accounts. And the reason for that is because you want to organize it in the way that you're going to set up your financial statements. So you're going to have assets, liabilities, shareholders' equity accounts, and then revenues, expenses, gains and loss accounts at the bottom. And then within assets, you're going to organize them between current and long term. Alright, well, in this video we walk through a series of journal entries and we created T accounts and finally an unadjusted trial balance. So hopefully this was good practice for you, and I appreciate you watching. Take care. I'll see you very soon.